Good morning and welcome to the Harmony Energy Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paul Mason, Managing Director. Good morning to you, sir.
Good morning, everyone. Thank you for taking the time to join us this morning. We're really pleased to have the opportunity to take you through the first year of Harmony Energy Income Trust, the annual results, and also bring you up to date with the recent NAV updates. The front cover here on this presentation shows our flagship Pillswood project. That's the largest battery energy storage project in Europe at 196 megawatt hours. And we're going to show you just a quick video to demonstrate the construction process and give you a feel for how these things come together before going into the main body of the presentation. So I think what that video really demonstrates is that whilst we are constructing a lot of assets, the process is actually very simple in terms of bringing in pieces of equipment which are constructed largely off-site, putting it together. So we're very keen to make this as smooth as possible. But whilst we have a lot of projects under construction, we're not taking on a huge construction risk in sort of the traditional sense of the word that you would see with some other technologies. So hopefully that video was helpful in demonstrating that. Just to introduce the team in front of you, you've got myself, Paul Mason, Managing Director. I've been in the energy sector for around 14 years, starting in energy from waste, moving through solar, hydro, pumped hydro, and into batteries. I've been exclusively focused on battery storage in GB since 2016, and I've worked with Harmony since that time as well, really looking at the commercial aspects and how do you monetize storage when we didn't have those revenue streams which the traditional renewables had able to lock down. Max, would you like to introduce yourself?
Yes, hello. Lovely to meet you. My name is Max Slade. I'm Commercial Director of Harmony Energy Advisors Limited. I've been working side by side with Paul since 2014, when we first started looking at the energy space together, and then, like Paul, have been fully focused on the battery storage sector in Great Britain since its infancy in 2016. However, my background is slightly different to Paul's, and that my background is legal, predominantly corporate law, but then since about 2011 I've been branching out to private equity and doing some independent consulting and investment banking work as well.
Okay, so just in terms of the structure of the presentation today, we'll give you a bit of a financial overview and talk about the year since IPO, walk through the key milestones. Want to recap in terms of the investment proposition and the opportunity and why we're here doing this, and also highlight some of those key characteristics which differentiate the Harmony Energy offering from others. We'll give you an update on the portfolio as it stands today and where we see that going. A bit of a deep dive into the NAV progression that we've seen over the past 12 months or so, and then move on to talk about the forward-looking ESG reporting and metrics that we're looking at measuring, and also looking ahead to the revenue streams and portfolio growth that we see for 2023 and beyond. So just to give you the overview, so the figures on the left-hand side here are bringing us up to the reporting period, which is an end of October year end. But we've had a very busy few months since that as well. So we'll probably focus more on the right-hand side here, which brings us up to date to the end of January, which is our latest NAV update that was published recently. Just pull out a few key highlights. So at IPO we had 210 million pounds market cap. That's grown in terms of NAV to 285 million pounds over this period. So we've had growth of around 27%. We've put in place some debt facilities to allow us to keep growing the portfolio and structured those in a very flexible way so that we are really always focused on maintaining our dividend cover and giving ourselves flexibility to grow in a sustainable way. Very pleased that we're into our 8p dividend period, which we set out at IPO, and we paid or announced the payment of the first quarterly 2 pence of that this year, which will be paid in the next few days. And we did pay the 2p per share dividend in 2022 as well. Just to give you that in slightly diagrammatic form and pull out a few of those highlights. So again, we've got Pillswood coming online, huge milestone for us, the first operating asset. So we IPO'd with a full portfolio of construction assets. So Pillswood coming online, the biggest in Europe, a really big milestone for us. Coming through to February, really we've had such a busy period, extending our debt facilities, signing up new battery suppliers, real success in the capacity auctions, which we'll come to talk about a little bit later when we get onto to the revenue streams. And as I say, declaring that 2p dividend, as well as publishing our first annual report. So really busy period, lots going on, and really setting up foundation for transitioning from that construction portfolio into an operating portfolio and delivering on the dividend promises.
So just picking up on the key characteristics and the overall investment proposition, Harmony Energy Income Trust PLC is a dedicated battery storage fund and focused entirely on Great Britain. And a key differentiator for us is our choice of duration. And when I say that, I'm talking about for how long our projects can charge or discharge at its maximum power capacity. As this sector has grown since its infancy, battery storage duration technologies have increased. To start with, we were looking at predominantly half-hour long batteries. The current average in the UK is about 1.2-hour duration batteries. Our portfolio is exclusively 2-hour duration batteries, and that gives us not only upside opportunity, but also downside protection, and we'll expand on that further in later slides. The other key differentiator is the point of acquisition. The trust is able to acquire projects when they hit shovel-ready status, and there is a bit of a differentiator here because shovel-ready is a term used in the industry to basically mean the 3 key components of a battery site are in place: planning, lease option, and grid connection deposit paid. Harmony Energy Limited, which is the sister company of Harmony Energy Income Trust, they originate and incubate the pipeline and develop that to a stage where we would say it's more like shovel-ready plus. And by that I mean that we've taken one step further. We have run tender processes to identify key suppliers, and we've agreed material terms such as pricing and timetable for such key suppliers. And that means that at the point of acquisition for the trust, that is slightly more de-risked than it would have been if we were acquiring a normal shovel-ready status from other third parties. It also minimises the time between point of acquisition and point of construction start, which is very helpful for us in terms of having confidence in the overall build-out programme and portfolio growth. The trust offers attractive return profile of 8 pence per share dividend and a target total return of 10 to 12% IRR. The sister company I mentioned, Harmony Energy Limited, also has extensive track record and expertise in developing, building and managing BESS projects, having done so previously on at least 2 projects, which are now built and operating, and we use those very much as a proxy to the construction portfolio that we acquired at IPO, being similar in design. They are Tesla equipment, managed by Tesla in terms of revenue optimization using their AutoBidder software, and built using similar budgets and similar timetables. So very much cookie cutter approach, trying to roll out our portfolio along the same structure and contracting program as we've done previously. The other big thing to mention about the income trust and its opportunity is its access to a large identified and captured portfolio pipeline. We entered into an exclusivity agreement with Harmony Energy Limited for 1 gigawatt of pipeline, of which we have now bought 494 megawatts, and therefore there is 505 megawatts of such pipeline left to acquire over the coming years. And we have very strong visibility over that pipeline. We understand all the relevant issues and the costs and benefits of that pipeline, which puts us in a really educated position when we make acquisitions.
So just to move on to a bit of the background around the market opportunity and why we're here. Clearly, batteries are here, and energy storage in general is here to support the rollout of more intermittent renewable sources. So solar and wind clearly generate electricity when the weather conditions are right, rather than necessarily when the demand is there. So we need storage to come alongside those intermittent sources in order to allow National Grid to balance the system. So the charts on this slide show the top right is National Grid's forecasts under the 4 scenarios that they forecast for rollout of solar and wind deployment, and on the bottom right we've got battery storage deployment. And it's just interesting to take a look at where we are on this journey. So the blue line in the middle, the system transformation line, is National Grid's effective base case. That forms the basis of their 5-year plan. And we're currently tracking about 6.5% above that deployment in terms of solar and wind, but we're actually almost 10% behind that deployment in terms of battery storage. So you can see this divergence, and that's driven by a number of things, but sure, just the scale of solar and wind deployments, the fact that they're backed up by government subsidies, and there's a very well-oiled investment machine to deliver on those on that solar and wind deployment. They come in big projects through offshore wind driving this to a large extent. Battery storage will always lag behind because the projects are smaller, the revenues are less certain, so we have this merchant revenue environment, and the investment case is still being built, so investors are becoming more comfortable. But one of the big things we're seeing is actually grid connection access is slowing down deployment of battery storage as well, and that's an area where the Income Trust is really well supported through that relationship with Harmony Energy as a developer, which Max has just talked through. So we see this demonstrating that the fundamental reason we're here remains very strong, and the principles are very strong. So how do we monetize battery storage? Well, what's going on? Battery storage, as I say, sits between that generation and the end users and balances the system. And there's 3 major ways that battery storage does this. The first one, ancillary services. That's short-term contracts with National Grid. The battery is paid an availability fee and is sitting there ready to respond to a problem, which could be a power station tripping out, could be wind is much lower than forecast all of a sudden, but the battery is sitting there ready to very quickly ramp up and start generating power to replace whatever's missing, or it can work the other way and the battery can very quickly consume power if there's an oversupply. So that's how batteries have historically earned their money. And that's been very, very successful for battery storage of all durations. But really, the focus there has been on shorter durations, as Max said, 30 minutes to 1 hour batteries. Numbers 2 and 3 here, wholesale trading and balancing mechanism. Together, we see these referred to as arbitrage. So this is buying cheap power and selling expensive power. So we're effectively, through wholesale trading, you're buying cheap blocks of power, typically when there's an oversupply of renewables, maybe overnight when demand is low and the wind is blowing, and then putting it back onto the grid in the evening when demand is higher, and we're displacing gas power at that point. So there's a price spread between those points, and that's been a pretty successful way of optimizing battery storage revenues over the last 12 months or so. The third one, I think, is where we're going to see a real change this year. We're going to see much more focus on the balancing mechanism. So this is the final ability for National Grid to balance supply and demand. The wholesale markets close 1 hour before delivery of power, and then National Grid spends that hour buying and selling power to make sure that supply and demand is matched in real time. And this is where batteries have a real advantage of being very quick and flexible. So those are characteristics which are valued by National Grid, and they allow National Grid to buy exactly what they need at any time. And they're buying and selling power in every single half hour, and they're doing it at price spreads which exceed those that you would typically see in the wholesale market. So it gives batteries a chance to earn a little and often throughout the whole day. And we're starting to see this really pick up this year. And National Grid has a real focus on deploying new systems and processes over the course of this year to give batteries even better access. So this is definitely one to watch from our perspective, and forms a big part of our investment proposition going forwards. Why do we focus on 2-hour batteries? Well, 2-hour batteries we always saw as giving the best range of potential outcomes. So when ancillary service prices are high, you didn't necessarily get additional revenue for those ancillary services. It wasn't valued, but the 2-hour battery can do those just as well. And when ancillary service prices are low, you can switch out of those services and into trading. And because you've got twice as much power to buy and sell, you can make almost twice as much revenue. So the range of revenue strategies you have with a longer duration battery mean you've got more options and you're less sensitive to declines in ancillary services. So over the course of 2022, you can see the difference here between average 2-hour duration batteries and average 1 to 1.5 hour duration battery revenues. Strong performance from all durations, but the 2-hour battery outperforming in every single month there, as we would expect to see. To break that down a little more and talk about what's driving that, we plotted the average 2-hour duration revenue stack on the right-hand side here. The blue bars represent ancillary service income. So you can see, particularly at the start of the year and up until really sort of July, ancillary services being the dominant source of income for even the 2-hour battery, but the 2-hour battery having more options to top it up with trading revenues on top of that, the green bars. So the arbitrage, that captures wholesale market and balancing mechanism. Most of that over the course of 2022 was wholesale market trading. On top of those two revenue streams, we've got the purple bars, that's capacity market. So this is another contract with National Grid. It's quite passive income. The battery's paid an availability fee, again, to be ready in case of a severe shortfall that's projected by National Grid, and the battery would then have to generate power for a 4-hour period. That really complements the other strategies. Those short periods are typically times when you'd want to be exporting power because the price is high anyway, so very little opportunity cost of providing that service. In terms of revenue source, for new build batteries, we can get up to 15-year contracts in the capacity market. They're CPI linked, so it can be quite an attractive add-on, albeit it's relatively small in the grand scheme of the revenue stack. But what I really wanted to focus on this slide was the correlation here between the DC, that's dynamic containment price. That's the biggest ancillary service which National Grid procures in terms of the number of megawatts they're procuring, and the shape of that price. And you can see it really fall off from the summer and come down pretty steeply towards the end of the year. And that matches very closely the average GB battery revenue, and for a very good reason. That was the key source of income for those batteries. But what's interesting is that as the price comes down and that starts to flatline and the GB average revenues are flat at the end of in October, November, December, the 2-hour battery revenues are still growing. And they're growing because we've got this ability to step out of those ancillary services and into the arbitrage activities and make more money through buying and selling power. And that's a trend that we expect to see continue in 2023 and beyond. So the divergence between those shorter duration battery revenues and longer duration battery revenues.
So that was a summary and explanation of the first key differentiator being the fact that the income trust has exclusively 2-hour duration battery assets in its portfolio, being the only dedicated battery storage fund in the UK to do that. The second key differentiator, as I touched on earlier, is the point of acquisition, and that Heat PLC is able to buy projects oven ready, shovel ready status. So having had all of the more binary, higher risk activities already performed, and the 4 columns you can see here represent the sort of 4 major elements of originating and constructing and operating a battery storage project. The early stage development is those 3 key items I mentioned earlier: securing the lease, securing the grid connection, and securing the planning. And it's worth highlighting how important out of those 3 the grid connection is. It really is what drives the whole investment process. Without the grid connection, the project is worthless. The grid connection also is an asset in perpetuity. Once it's allocated to the SPV, it doesn't have a fixed life. It continues, and that means that we can be comfortable in terms of technology obsolescence. So if a technology over the lifetime of our cash flow becomes outdated, then there's always the opportunity to switch it out and put a new technology in. But that grid connection is still there, the capability to plug in X number of megawatts at that particular site. So that's a key asset for the trust. And so but what we do on top of the key shovel ready elements, we also, as I said earlier, move a little step forward. We move a step further forward in the contracting process, identifying the battery suppliers and the balance of plant contractors, agreeing material terms, and then minimizing that gap between point of acquisition and the start of construction. And what this allows the PLC to benefit from is that it's more de-risked than a normal arm's length third-party transaction. But at the same time, it allows the PLC to benefit from the valuation uplifts that it naturally gets as it moves from being a development project into a construction project, and then again up to an operating project. And our discount rates adjust to reflect that. Just to give you an overview geographically of our current portfolio, as I said, 494 megawatts. The Pillswood project, being coloured in teal, is at the point of recording the only operational project. However, the Broadwich project, our second project, is also coloured in teal here because it is energised, which means the grid connection has been completed and there is power flowing to and from battery as we speak. However, we're still going through testing and commissioning periods, so we are not fully operational yet, but intend to be so in the coming days. So we colour both of those in teal for the purposes of that, to reflect that it's operational really. Behind that, we've then got the rest of the portfolio is under construction, except for the Rye Common project, which I'll touch on again on the next slide. And then behind our current portfolio, we have a further 400 megawatts plus of what we deem medium-term pipeline, which is available under that exclusive right that we have with Harmony Energy Limited. And we have good visibility on that, and we're tracking the progress. And we feel that that 400, or just shy of 420 megawatts, can be acquired and be connected over the next 36 months. And then, just to be very clear, we are not exclusively bound to acquire projects from Harmony Energy Limited. We do try and source shovel-ready projects from other third parties. However, what we do find is that the quality of those projects and also the acquisition value that we bid for those projects is not. It's better value for us to be sourcing these projects from Harmony Energy Limited for reasons that Paul will expand on in just a moment. Just some photos of up-to-date shots. So we have actually had Tesla Megapacks delivered on 4 of our sites already. 328 megawatt hours of battery Tesla Megapacks have been delivered to site. The largest of those, of course, is the Pillswood project, 196 megawatt hours, 78 Tesla Megapacks. Just to put that into context, 196 megawatt hours is enough to power 300,000 UK homes for 2 hours at any one time. And obviously, the battery, being a battery, needs to charge up and then discharge again. But you know, so that's why we refer to the 2 hour duration here. Broadwich is, as I've mentioned already, the next in line, going to be fully operational very shortly, and that's 11 megawatts, 22 megawatt hours. Farnham and Rusholme both have Megapacks installed on site, but they're just undergoing the final grid connection activities, so they're coming on in the very early summer, late spring. And then the Bumpers and Littlewraith projects, they're quite large. Littlewraith up in Scotland, Bumpers in Buckinghamshire. They are further behind in the construction programme, and that programme is dictated by the grid connection timetable. It's not out of choice. We would rather have everything on straight away, of course, but the grid connection timetable is designed so that we can stagger the portfolio and bring on project after project in a methodical way. So those projects are still undergoing site enablement works. Littlewraith actually is more progressed than Bumpers. Littlewraith is Tesla have just mobilised on site there, and the Megapacks are en route. Bumpers a bit further behind, having just cleared its pre-commencement planning conditions. And so this chart sort of demonstrates nicely what I was just describing, like the methodical rollout of our portfolio. Those projects on top have already hit commercial operation date. And then Broadwich, as you can see, has already energized, but then commercial operation date will be very shortly. Farnham and Rusholme coming on behind those. Bumpers and Littlewraith in Q3, Q4. And then Wormald Green and Hawthorne Pit. Now, these two projects are not Tesla projects. These two projects were acquired in December, and we underwent a supplier diversification process, simply because we thought that concentration risk was such that it's always a good idea commercially to have an alternative supplier to Tesla. We've got no problem with Tesla. We would love to work with them again, and no doubt we'll do so. But we thought it's safe to diversify our supply chain. So Wormald Green and Hawthorne Pit have been allocated to our new contractor, Envision, and we signed those contracts very recently in February. So those two projects are due to come online now in Q1 and Q2 of next year. The Rye Common project is still as yet unfunded. Everything in grey you can see here is completely fully funded through either equity or our debt facilities. The Rye Common project being the exception, so that's still categorised as shovel ready, and we are continuing to explore funding options in relation to that project.
Okay, so to give a bit of a deep dive in terms of what's driven that NAV growth that we've seen over the past 12 months. So the biggest driver has been a reforecasting of revenue. So we're in this environment, we don't have long-term contracted income aside from the capacity market, which I mentioned is a relatively small piece. So revenue forecasts form a really key part of the valuation process. And a big driver of those revenue forecasts is gas price. So we've seen since IPO gas price shoot up as a direct result of the Russia-Ukraine conflict, and that has shifted up the near-term revenue forecast significantly. I'll come on to talk about those forecasts in a bit more detail in terms of how we form those and where we source them from. But across the whole market, forecasts have gone up. And that's been on top of really strong performance from batteries that actually showing that they can deliver in the various markets. So this biggest bar, the 12 pence per share bar in the middle here, really being the main driver. Very much linked to that is actually the acquisition of Bumpers, which accounted for an 8 pence per share uplift purely on acquisition. And so the discount that this project was acquired at was a result of the structure of the IPO and the relationship between the income trust and Harmony Energy as the developer of the project. So at IPO, that the mechanic for how that project would be acquired was set, and the pricing was set, and the pricing was fixed to total cost pounds per megawatt of £750,000 per megawatt. And the consideration paid to Harmony Energy was a calculation which was based on £750,000 per megawatt less the project costs. And what we saw between IPO and the point of acquisition for the Bumpers project was that costs increased quite a lot, so that the consideration paid to Harmony actually ended up being zero, and the project was put into the fund at a value of zero following the mechanic. But we'd also seen these big revenue increases, so the value of the project had increased. So that effectively allowed the income trust to benefit fully from those revenue increases without suffering any of the pain of the cost increases. So again, demonstrating the relationship and the value of this relationship between Harmony Energy Income Trust and Harmony Energy, the developer, in terms of flowing that value through and really protecting the interests of the trust shareholders. Other increases were really due to the process of moving through the construction timeline. So where we get roll forward, that's referring to the fact that we're moving through the construction window, we're getting closer to income generation. That increases the value of those projects just from a timing perspective and reducing cash drag if you enter at a later point. And we've reduced discount rates. So the initial reduction to discount rates, again, just reflecting the fact that the projects were acquired at an IPO on relatively attractive terms. So there was a relatively immediate reduction in discount rates and upward valuation. And we've seen that post year end. So in the second part of this bridge, we've got a change discount rate largely reflecting Pillswood becoming operational, and also tweaking down the discount rate for the rest of the projects which are under construction. And that's really a benchmarking activity and bringing those projects which are under construction in line with the 3 new projects which were acquired in December. So at the shovel-ready stage, we see a lot of publicly available information around what developers are being paid for shovel-ready projects, and refer back to the developer shovel-ready model and our version, which is actually a bit more developed. But we frequently see acquisitions of projects at that shovel-ready stage of £130,000 to £160,000 per megawatt for those project rights. The 3 projects which were acquired in December were acquired at £117,000 per megawatt on average, so below those market comparators, and that represented a 10.3% discount rate. So we just tweaked down the pre-operational discount rate on the whole portfolio to reflect that and bring everything into line with those more recent market comparators. And all of this is done in collaboration with Mazars as our independent valuer. So they're always looking at discount rates, revenue forecasts, but also pounds per megawatt comparators to sense check the process. And we can't really talk about discount rates without talking about revenues. As I say, the revenue curve that we're applying and the discount rate that it's being applied to need to go hand in hand, and so that Mazars process of benchmarking really important. I've shown on here the revenue from the Contigo project, which was a Harmony developed project. It was built by Tesla and is optimized by Tesla, but doesn't form part of the trust. It was built before IPO. But as Max said earlier, we do use this as a good proxy for what we expect to see in the fund, because it's so similar in terms of technology, optimization technique, duration, etc. So in 2022, that earned just under £300,000 per megawatt, so £287,000 per megawatt. The forecast drops off quite significantly into 2023. One of the key drivers of that is that our forecast from a valuations curve perspective is very much based on arbitrage revenues and not really stacking on additional value from ancillary services. The reality is we believe there will always be opportunistic chance to step in and out of those services to maximize value, but we don't factor that in to our valuations going forwards. And also the shape of this curve that I mentioned earlier, the revenue forecasts had shifted up the front end of this curve. So from 2023 to 2026, those elevated bars are really down to the independent forecasts that we procure and their view of gas pricing going forward. So the shock in the near term to gas pricing, and then coming down as it's forecast that Europe sources sustainable gas supply, not reliant on Russian imports. So that's a really big driver of the front end of that. We've talked about the discount rates here, but it's good to talk about the cost per megawatt. So I said at IPO we were looking at an all-in cost of £750,000 per megawatt. That's increased to, on average, say £900,000 per megawatt, and that's really driven by that revenue increase. So the value of the projects has increased. I think the costs have increased as well. So the amount being paid to the developer has actually stayed relatively constant, but still maintaining obviously the attractive return profile. And when we compare to what we see going on in wind and solar, where discount rates have started to creep up in line with interest rates, we're still seeing downward pressure on discount rates in the battery space as investors become more comfortable with the track record and seeing those revenues actually flow through. And that's something that we've always said we expect to see a convergence of sort of unsubsidized solar projects compared to battery storage projects. There is still probably a 300 to 400 basis point spread between discount rates in those places, and we really believe that batteries are well placed to tackle effectively the same risks that both of those technologies are exposed to. Another excellent sense check for whether the fund is getting good value for money in projects it's acquiring is when, as Matt said, we tried to acquire projects from third-party developers, and we plug this valuation, this revenue curve into the model. We plug in the discount rate, and we can make an offer to a developer to buy a project on that basis. And we are frequently told that we are not competitive with what the market is paying. So really highlighting again the value of that relationship with Harmony Energy as the developer.
It's important for us to highlight and emphasise our ambitions and passion around environment, social, and governance. When we set the PLC up, and we wanted to make it clear that we have very high targets in this field, not just obviously by nature of what battery storage does and how it enables the transition to net zero. That's a bit of an obvious point, but also from a social point of view and a governance point of view. Harmony Energy Limited, our sister company as the developer, has opportunity to not only make a positive impact in local communities, but also increase biodiversity at its sites. And the best way of doing that is by having the right procedures, ambitions and strategies in place right from the earliest stages of planning. And this is another benefit that the relationship brings between the PLC and its sister company, that the investment advisor has the opportunity to oversee and influence the implementation of those early stage strategies in order to really maximize net biodiversity gains, such as the creation of ponds and other sort of mini wildlife habitats, planting, landscaping, etc. On top of that, we also set up community funds for individual projects, and there's also another fund which is explained in our prospectus, which the non-exec board of Harmony Energy Trust, Income Trust PLC, have established in order to create a foundation for underprivileged apprenticeships, etc. Not just in the battery storage space, but wider as well in the investment trust landscape. So what we did last year was we spent the time examining, putting our strategy in place, setting the framework, examining the various principles and frameworks we could sign up to. We've elected to sign up with UNPRI, and we will be reporting on a voluntary basis with them this year before doing it on a mandatory basis next year. And similarly, we are intending to report fully under TNFD and TCFD, which is a very high standard. We're also looking at SFDR, but we see that very much as the next step. So yeah, it's a very exciting time for us. We are building our team at the investment management level, and we're looking to report not just on the fund itself, but also at the project level, and also at the investment advisor level, being a key supplier.
And just looking ahead for 2023, just pick out a few key themes. I think, as I've mentioned, we really are expecting to see that divergence between 2-hour and 1-hour duration battery revenue performance grow as ancillary services remain relatively low priced for the foreseeable future. We think more revenue is going to come from arbitrage, and optimizers are going to really start to make the difference, and you're going to start to see some winners and losers in that space. We think the balancing mechanism in particular is going to be a really important part of the revenue mix, and that will allow batteries to be earning money throughout the day rather than just looking for those big overnight periods to buy and the evening peak to sell. There'll be opportunity through forecasting error from intermittent renewables to buy and sell throughout the day, which is going to be a really nice thing to see come through. From our side, looking at the portfolio, really continuing the focus on getting the projects operational and going through that construction process. We're continuing to work with the developer in terms of the future pipeline and making sure, as Max just talked about, that those projects are really well set up, and we're in a great place to benefit from that relationship. So, and from a governance perspective, Max has really just covered all of these points, but we've spent the year baselining really and getting ourselves ready. So this year is going to be that transition from the baselining methodologies and setting up how we're going to report to actually starting to report on some of these key areas. And that concludes our presentation, and we'd now like to answer a few of the questions.
Paul, Max, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Paul, Max, as you can see, received a number of questions throughout today's presentation. If I could just ask you to read out those questions and give responses where it is appropriate to do so, I'll pick up from you both at the end.
Yeah, great. Thank you very much. The first question I think we've covered. So the question is, what was the reason that the trust was able to acquire bumpers at a discount and giving the immediate AP uplift to NAV, and are such transactions likely to reoccur, or was it a one-off? So I think I've answered the question in terms of how that happened, in terms of the pricing mechanic being set at IPO and the fundamental movements in cost base and revenue forecasts between the point of fixing the pricing mechanic and actually acquiring the project. So I think we don't expect to see that level of benefit again. But I think what we do see is that it highlights, as I say, the value in terms of the relationship between the income trust and the developer. But I think we expect to see more that we'll be acquiring and then very quickly constructing with pricing locked in from now on. So I don't expect to see that level of uplift on acquisition again. I think that was a bit of a one-off. So the next one, so discount rates have already been reduced a little since the IPO to 10 and 10.3%. Is there an estimate for how much further this process has left to run, and where discount rates for battery storage might settle relative to UK solar and wind assets? So it's difficult to know how far they will come down, and especially when we're in an environment of interest rate increases. But I do think we will continue to see convergence between the technologies. I think battery storage is proving itself, and the revenue streams are becoming a bit more transparent, so that people can start to see the real performance flow through. In terms of how far to go, I wouldn't be able to put a number on how low I think those discount rates would go, but I think it's quite telling that you see the acquisitions at shovel-ready stage. As I say, the valuations are significantly higher than we are paying to Harmony Energy as a developer there's been a real lack of anyone wanting to sell in the operating assets. So putting a discount rate or a valuation on an operating asset or portfolio is a bit tricky, but I think it would be very sought after if anybody did take an operating portfolio to market, and I would expect that valuation would be quite high. Yeah, very difficult to put a discount rate on that. But I think further track record will just continue to sort of give confidence and bring down those rates and converge with solar and wind.
The next question is around potential risk of oversupply. So there's a question saying, do you see a risk of oversupply in BESS? And the answer to that is we think that's protected against for two key reasons. The first is that, as Paul mentioned earlier, battery storage will always lag behind the deployment of wind and solar, and so the market opportunity should always be there. And I think a key point here is that battery storage is not subsidised as an asset class, and whereas wind and solar are, and therefore battery storage needs to self-regulate and react to market signals set off. So the more the intermittency increases, the more volatile the system becomes, the harder it is for National Grid to manage the system, therefore the more help they need from batteries. That will send market signals to developers and contractors in order to keep building batteries, but when the market softens, then the rate of deployment should also soften. That's one natural sort of handbrake. The other handbrake is, of course, the grid connections, which we've mentioned before. It's quite well publicised that new grid connections are becoming harder and harder to create and energise quickly, and we're hearing about delays into the 2030s now. That's something that Harmony Energy Income Trust is quite nicely insulated against because of our mature and captured pipeline that we have the advantage of, and these already have grid connection offers, which are all capable of connecting at some point over the next 3 years. So we feel the medium term, we are very well positioned to strategically take advantage of that wider infrastructure issue.
Yeah, I think just to add on, there was the question around oversupply was also talking about existing funds whose starting point was solar and wind and starting to move into the battery space, and does that create a particular risk? I think it's interesting that most of those players are actually building standalone batteries rather than retrofitting battery onto existing projects for the moment, and I think there's good reason for that, and it's both regulatory but really driven by grid. As Max has said, those projects won't have import connections, and simply charging batteries from a renewable source on site will not give you access to the wide range of revenue streams which you need to make the battery revenue stack work. So I think most players are looking at it from the perspective of starting with standalone BESS assets, or projects which have been developed as co-location projects from the outset. In terms of our own ambitions, we do have the mandate to add on associated renewables to our projects, and it's something we will look at. Right now, to buy solar or wind project rights wouldn't fit within the return requirements of the income trust, but it's something that is on our radar in terms of self-developing and adding on to our battery storage projects in the future. So it's something that we're looking at, but no immediate plans to act on. And there was a separate question which is a bit linked to this, which was around whether vehicle to grid, and particularly with our relationship with Tesla, whether that gives us any advantage or disadvantage. And I think, without getting into the arguments about whether or not vehicle to grid will become a big thing, I think the answer is very similar. If there is a large amount of vehicle to grid that starts to act as a big battery, we don't see saturation being a big risk, given our primary focus is on wholesale and balancing markets, which are very deep markets, and we're not fighting against other batteries. We're really displacing gas in those markets. So no, we don't see an immediate risk from either dedicated battery funds, co-located battery funds, or vehicle to grid. There's a question around, does the company have any involvement with the Silicon Valley Bank? And if so, what's the extent of the involvement? No, we do not have any involvement with Silicon Valley Bank, so nothing for us to worry about specifically on that case. And then there is a question around the our C-share fundraise last autumn, in which we raised £15 million of C-shares. We were targeting a raise of 130 million pounds of C-shares, and therefore, what does that mean in terms of the projects and our ability to construct those projects? So I think Max did cover this, but just to reiterate, all of the projects which were in grey. So I'll just flip back to the slide just so we can visualize it. So all of the projects in grey, including Pillswood clearly, which is operational, are fully funded. So and that's a combination of the equity raises that we've done, plus the debt facilities which we have in place. I did mention that the debt facilities are quite flexible. They're currently undrawn, and therefore we have. We still have those facilities to draw on, but we don't have to draw all of those facilities. So we will draw down on the debt in line with construction milestones. And if we were to raise more equity before we draw down on that debt, we don't have to draw all of it. And if we raise more equity in the future, once we have drawn it, we've got very flexible terms which will allow us to repay quite a lot of that very cost effectively. So we've been very careful to structure our debt raising to give us maximum flexibility to continue the growth of the portfolio, but not overburden us in terms of debt service. It's worth mentioning as well that actually the Rye Common project, we have got sufficient funding in place to pay the grid connection payments, and that's really important to keep the timeline of that project, so that the critical path of this project is really grid connection. So we do have time to assess options. And as I said earlier, an ultimate downside scenario, which is not what we want to do, but we could, it would be that we could sell that project, and we'd be confident of selling that project at a higher price than was paid for it. So a question around forecast revenues and what proportion come from the balancing mechanism. So at the moment, it's relatively light, and the reason for that is because we procure forecasts from 3 independent sources, and the reason we get 3 is because the long-term forecasts that we get 2 long-term forecasts which are very fundamentals based, and those inherently have a lot of averaging in, which misses out a lot of the value which battery storage can benefit from, things like average weather conditions, average plant availability. But we know from experience that where batteries really excel is when there's a few of these factors come together. So we end up with a low wind period, the French nuclear fleet not operating for a while, combined with another plant outage, and all of a sudden there's a big shortage for a period of maybe a couple of weeks. And that would give battery storage a real ability to outperform for that short period of time, and that isn't really captured in the long-term fundamentals models. So we add on to that a short-term model, which is a bit more based on historical analysis of how batteries perform in various market conditions, and then mapping that out onto the projected market conditions over the short term. But for that reason, balancing mechanism has historically been quite a small part of what batteries have done. So it actually, I think, is undervalued in these revenue forecasts, particularly over the long term. I think these forecasts are based on more wholesale trading with balancing mechanism tweaking around the edges, and I think there's a lot of capacity for batteries to actually earn the majority of their income from balancing mechanism, which could see higher revenues come through. So yeah, right now it's a pretty small proportion. I don't have the precise figure to hand, but yeah, it's not a significant amount. But I do expect it to become significant as we start to see batteries participate this year, and that gives those forecasters more data to actually build into their methodologies. Is there a fixed price arrangement for the acquisition of further projects from the pipeline, as was the case for the IPO pipeline? So if I go back to this slide, so there's not a fixed price, there is a fixed pricing mechanic. So the pipeline agreement, which was signed at IPO, gives the company the right of first refusal to acquire projects from Harmony Energy Limited at a floor discount rate of 10%. So that means that if discount rates continue to come down and the market is effectively paying 9% discount rates, the income trust will have the ability to buy at 10% and immediately increase the value of that project. So we would see immediate NAV benefit if that was the scenario. You can see right now we still acquired projects slightly over the 10%, so we're not quite at the point where that mechanic is biting and creating that immediate value uplift, but we could well see that in the future. And that goes up to a gigawatt of total capacity. Once we pass the gigawatt, the income trust then has a right of first offer, which means that fixed pricing mechanic, that fixed discount rate is removed, but the income trust still has a first option to make an offer on any of Harmony Energy's pipeline, and that covers any technology, not just standalone battery storage. It also covers co-located and solar or wind projects as well. Commissioning dates for the construction assets. How confident are we in the commissioning dates? So we have recently announced some delays of a few weeks to the Farnham and Rusholme projects, and we're confident that those new dates are now very, very achievable dates. They are largely grid connection led, so DNO led. So managing that relationship is always a challenging part of the construction process, and making sure that you incentivize and properly understand the process that the DNOs are going through in terms of hitting those dates. But we're confident in hitting those now. From a bumpers and little wraith perspective, everything is on track and no concerns. So yeah, we are confident in the current projections.
Yeah. It's important to note, again, this is another benefit from the investment advisors back office team. We've got a large experienced team of technical and grid experts who work very closely with the DNOs, the distribution network operators, who are responsible for providing and procuring the grid connection infrastructure. But you have to manage that interface between the DNOs doing their parts of the work, the balance of plant contractors who are responsible for the site assembly, the foundations, the on-site transformers, etc. And then also, obviously, the key one being the battery storage equipment supplier, Tesla or Envision in our case. And managing the interface between those three counterparties is challenging, because they all have to dovetail in order to hit the overarching program. So that's what we really have got good experience in, and part of that is paying the grid connection milestone payments as quickly and efficiently as possible, and then making sure that money is put to good work by the distribution network operators in order to make sure they're ordering their long lead time items on time, and having our finger on the pulse in terms of how long those lead times are, because that has shifted a lot in the last 24 months in the post-COVID era.
Great. And I think that has answered all of the questions we've received. So if there's any last minute ones, there's a minute or two left, but if nothing comes in, then
Paul, Max, thank you very much for that. I think you've addressed all those questions from investors, and of course the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Paul, could I just ask you for a few closing comments?
Yeah, so I think we've really had a strong year, building a strong foundation, and we want to really build on this and transition out of this construction period and into an operating period where we really start to see the proof of those revenues flowing and generating the income to pay those dividends. We think that the 2-hour battery is absolutely the right place to be right now in terms of duration. I think that we're really going to see that divergence between 2-hour duration batteries and the shorter duration batteries, and the benefits are going to really become very transparent. And the market opportunity really remains very strong. So we're seeing that acceleration of intermittent renewables, and we're seeing that the batteries are still struggling to keep up. So the fundamental reason we're here and the story behind what's driving our ability to make these revenues remains as strong as ever. So we're very much looking forward to moving on and actually delivering for investors.
Paul, Max, thanks once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Harmony Energy Income Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.